Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Kathleen Smith, Chairman and co-founder of Renaissance Capital, a global IPO investment advisory firm. We're talking about the IPO market and the Renaissance IPO ETF, which is up almost 50% this year. Kathleen, welcome back on the show.
Thank you.
Okay, so we have seen very healthy demand for deals recently. It seems that the IPO market has rebounded since March. So to start off, could you give us an overview of the market? How many companies have gone public this year? How much money has been raised? And how does that compare with 2019?
Well, despite the COVID pandemic, the IPO market is in very good health. So far this year, we've seen 109 IPOs that have raised $36 billion. And that is ahead of this time last year by about 3%. If you include SPACs, the IPO market has raised $65.7 billion in 188 deals. And that would make that the total of IPOs and SPACs up somewhere between 30% in numbers and 50% in dollars. And the market has been trading well. The regular IPO market, about 70% of the IPOs being done are trading above their IPO price. Now, we had a very slow trickle in March until investors saw through what was happening with COVID. And even in a typically sleepy August, we're finding that this month looks like it will be the busiest, the most dollars raised in the month of August ever. So we're going to do $8 billion of issuance, and through the data sets we haven't seen such a busy August. Now, a lot of it is the market is on pace to hit records that we haven't seen in over 10 years or so in terms of dollars raised. And we're going to see this rush of IPOs in part because we have an election around the corner and companies want to get out before that. And also, we're seeing a number of large Chinese companies come public and issue ADRs ahead of changes in rules about these companies having to comply with the accounting standards that regular U.S. companies comply with. So it's a very active time, a good time to be talking about IPOs right now.
Yes, very impressive. So we have seen many biotech IPOs this year. It's probably one of the best years for biotech IPOs. And that makes some sense because some of these companies are working on coronavirus testing or vaccines or treatments or other novel treatments. Then of late, we have seen a surge in tech IPO filings. Like just this week, Snowflake, which is a data warehousing company, Unity, which is a video game technology company, and Asana, which offers some productivity tools. So we saw their filings just this week. So could you tell us something about these sector trends that you have seen this year?
Yes, as it pertains to the very active healthcare biotech market, we are seeing the most active and highest returning companies coming from COVID or vaccine plays. And I'll mention CureVac, which is the best performing IPO of the year, up almost 30%, and Vaxcyte. Also, there's been interest in cancer biotechs. Kuros Therapeutics comes to mind, and many others. Drug discovery platforms, Schrödinger, which is backed by the Gates Foundation, has seen very strong returns, and Berkeley Lights. Medical devices, Inari Medical has done well, a non-invasive medical device company. and alternative medical delivery. We've seen Oak Street Health with Medicare clinics and One Life, which is also a clinic service company. These are the areas of healthcare that have done well, and many of them are playing into, I think, the current environment of interest in health during this time where health is of the essence, really, as we kind of move on and try to deal with the COVID crisis. When it comes to the tech area, that's also a very active segment, not as active as biotech and health, but a very strong returns, even before these new filings, which I'll comment on. And the areas of most interest in tech are enterprise software. The best performing tech IPO of the year has been BigCommerce, that makes online stores for retailers, and that's up over 300%. And other enterprise companies such as nCino, a digital banking play, Agora, API platforms. Also, I'll mention there's some digital consumer platforms that have traded very well, including Vroom, a used car platform, Lemonade, a digital platform for fast turnaround renters insurance, and Rocket Mortgage. And I guess lastly, payment processors in the tech area have been profitable, and Shift4 is one I'd note that has traded really well. Other sectors have seen interesting ones that are relating to the stay at home. One Water Marine, for example, the recreational boat company, has had a lot of appeal to investors. Some of the consumer staples companies like Vital Farms, that makes organic eggs, and Reynolds Consumer, making Reynolds Wrap, playing into the pantry theme. And then AZEK, which makes wood for decks. They're seeing strong demand. So we've had some really interesting IPOs. As I mentioned, over 70% of the IPOs done this year are trading above their IPO price. And mainly, I think the IPO market is really filled with a lot of new economy companies anyway. So this period we're in has really favored the kinds of companies that typically go public. I can shift to your comment regarding the recent tech IPOs that just filed, because we were looking at our data and found that the market's been very active and, as I just mentioned, very robust. But until some filings that happened this week, we have not seen a Silicon Valley-based tech IPO all year. Pretty incredible, when it's always been a most prolific area of IPO issuance. And possibly it's because we had such a challenge with some of these companies at the end of last year, including Uber, Lyft, and then finally WeWork, that we haven't seen many of these big unicorns tap the market. But that all changed. The code was broken, and we had these filings, as you mentioned, for Snowflake and Asana. They're all Silicon Valley-based companies. Unity and Palantir announced. So we are now seeing the breakthrough of some of these companies who are going to have to reconcile that disconnect between those high private valuations they've had and what the IPO market is going to give them when they study their financials.
Very interesting trends, definitely. So as you mentioned, that many companies are now racing to go public before the presidential election. So it seems that we'll have a very busy fall for IPOs. So could you give us your outlook for the rest of this year, and which are the biggest unicorns that are expected to go public this year?
Yes, we're thinking we could have a year that finishes up perhaps better in volume than, I think, 2014 when Alibaba came out. That was like an $80 billion year of issuance. So it won't be that big in terms of regular way IPOs, but that could be the benchmark. So the most active and highest volume year since 2014. We're expecting this rush. I will say that it gets a little dicey as you get nearer the election. Companies tend to want to avoid that period. And we do see a little bit of a dip around late October and early November. So there will be that, but we still think we're in a constructive market. We would look at, as long as IPO returns are holding up, that would tell companies it's a constructive market. So you can look at our ETF for that, and then also the returns on other companies that have come out. The very largest unicorns that we're expecting at the very top of the list would be Airbnb. And except for the fact that I believe Airbnb's valuation, which once was around, in private valuation, was around 30 billion, is now around 18 billion. So it's not one of the most highly valued ones, but it's certainly been one of the most anticipated ones. And they have filed confidentially and expect to see them move ahead in the next few months. We also have just seen Palantir file. That's been another long-awaited unicorn. It's another case of a company that had a private valuation of something like 26. In 2015, it was valued at 20 billion. And this filing is telling us that it'll be something more like an 18 billion valuation. So we're getting to see now the financials for Palantir, which have probably more losses than people expected. And the revenues are not quite a billions, but they're still losing money. And so I think that's the reason for this lower valuation. So investors are starting to look at that. The Palantir is going to come public through a direct listing. So that is, I think we can talk more about that, but that's going to be a kind of an interesting approach when we've only seen 2 of those so far. And it's still not a tried and true way to go public. DoorDash is also on this list. Investors, and that the restaurant delivery firm, that has a 16 billion private valuation. They're talking about the fourth quarter. And there are going to be so many others we don't know. We just saw Snowflake file. That one should be a $2 billion deal. And we think Robinhood, the stock trading app, which has about 11 billion private valuation, we think that one should file. So there's a lot we don't know, but we think these that I mentioned could come public. And then we do think that one of the very largest private companies that is Chinese, called Lufax, a peer-to-peer lender, which has a private valuation of about 38 billion, we think is going to try to tap the U.S. IPO market soon. So that will be, all these companies represent an awful lot of deal flow and should make 2020 a record since 2014 in terms of dollar raised and activity.
Definitely a lot to look forward to. So you mentioned confidential filing by Airbnb and direct listing by Palantir. So I don't think many of our listeners understand properly how the IPO process works and the difference between IPO and direct listing. So could you talk a little bit about those approaches and also what is confidential filing?
The confidential filing is basically an ability for any company that wants to go public to register and get their document vetted by the SEC before they reveal it to the public. So that's the process now. It was changed about a couple of years ago, and that is the common way. Companies want to proceed mainly because they want to have all their ducks in order and move forward when the timing's right. And so that's been an advantage in terms of the IPO process for these companies. The direct listing is a whole different thing. And we have seen direct listings and even SPACs as ways that companies have been trying to figure out how to avoid an IPO. And we think it's the IPO has a certain amount of price discovery that sometimes is hard. I'll call it the IPO thrashing machine, price thrashing machine. It's kind of hard to deal with sometimes. And if we see what happened with WeWork, it sometimes just has resulted in disastrous consequences for companies that really are not ready to tap the IPO market in terms of what they're able to tell investors and convince investors of both their valuation and their business fundamentals. So there have been ways to work around it. SPACs have been one way to go public without going through what I'll call the IPO pricing thrashing machine. And the other is a direct listing. Now, the direct listings are a way to go public by not doing an IPO, but basically filing the documents needed to be declared that you're a private company. So there's a type of documentation you would do if you're trying to issue shares to new investors through an underwritten IPO. That's a regular way IPO. And then another process where if you're filing 10Ks and 10Qs and following those regulations, you are already then, you're a public filing company. So if you have enough shareholders and trading just commences, you will then go public without an official IPO. They're kind of tricky to do because it's important that any company that goes through a direct listing needs to really work hard with the shareholder base and make sure that the shareholders are well informed about the companies. The two that have been done so far, one is Spotify and the other is Slack. Both of those happened, Spotify in 2018 and Slack in June 2019. So each of those have been public. And our studies show that 1 year after those IPOs, the aftermarket returns for these direct listings have been negative for investors. And we believe the reason is that the pricing of these IPOs has been high, which is fine, but it's hard for investors to make money, especially says there's no reason to rush to get into these companies if they're going to be priced like Spotify and Slack were priced. So the issue really with the direct listings are that the companies themselves want to get the highest price they can, and they want to be able to have insiders sell as soon as they can. And those are two things that aren't, that's one side of the equation here, but investors aren't looking for that. They're looking for an attractive price, and they're also looking for a certain amount of locked up shares so that management insiders are not selling before they have produced several quarters of earnings, which is what a lockup does, is it has them hold back for 6 months before they can sell. And so the earnings will at least meet the expectations that they set out in the market when they marketed their investment to the company to investors. I do note that Palantir has indicated they will have a lockup, but the shares that are going to come out and trade are going to be insider shares. But I do think it makes sense to have a lockup. I think that helps a little bit. Also, Asana is planning to do a direct listing. So after seeing the big Spotify and WeWork, we're going to see the action on Palantir and on Asana coming through. So it's going to be tested. But I will say what happens with product testing like this, you just look at the last ones that have been done and they tell us that there's no rush to buy anything on the first day of trading here, that you can watch and see how they trade to determine whether this is something that you want to hold, since the record is that we have seen is that they have been able to achieve very high prices right off the bat that haven't held up too well for investors who have held them for a year.
That's very helpful. Thank you for explaining. And you mentioned SPACs too. It's a special purpose acquisition company, which is also sometimes called blank check company. And I read just this week in the New York Times that SPACs have raised more than $30 billion so far this year versus $13 billion in all of last year. And we will soon have an ETF to track SPACs. And, a trend is hot when there is an ETF filing for the trend. And I'm actually praising the ETF industry because investors want exposure to those trends, and ETFs just provide a convenient way to access that particular trend. So tell us a little bit more about SPACs and what's behind the SPAC boom this year.
Yes, it's our view that the SPAC boom, it is a product that is set up in an attractive way for a hedge fund. So the blind pool is raised and it's invested in treasuries, and there are typically some warrants that come with the unit price. And the company has to make an acquisition within 2 years with that capital. And when it does, the company it acquires becomes a publicly traded company because it merges into the shell of a SPAC. And they tend to be done by leadership, sponsors that are knowledgeable in their fields. So it's been a way for companies that haven't been able to do regular way IPOs to find a way to go public, at least the way we've seen it. And so there's this, with hedge funds, the benefit here is you get to sit in the SPAC and get a treasury type of return, and then decide whether to, in fact, go along with the merger, because you can sell out if the merger isn't something you're interested in. So this works, especially if you're trying to moderate your downside, which a hedge fund is set up to do. They're absolute return funds. The issue is that we see, and we've studied, and I do think it's interesting to have an ETF set up for this, and the structure will be worth examining. We don't include any SPACs in our IPO ETF because we include only operating companies, and SPACs do not become operating companies usually for a couple of years till they make this acquisition. Our studies show, we've studied the 223 SPACs that have been issued since 2015, and of those, 89 have completed mergers. And of those 89, the average return is negative 18%, and the average median return was negative 36%. And that compares over that same period with average aftermarket returns for IPOs of a positive 37%. So there have been moonshots that have been done here that have done very well, which is why that average negative 18% on average versus the median of minus 36. There have been some moonshots that have kept the average, improved the average return, including DraftKings in particular, one of the most high-performing SPACs mergers so far. They're in the online betting business, and Virgin Galactica, and a number of others. But on average, most of them, if you're not really careful, these companies are not producing the returns that you would expect to get from this kind of vehicle. We've seen the amount raised has been incredible, but we have seen the first sort of cracks in the SPAC market with just recently we're starting to see deals that have been moved forward that are starting to be cut back in deal size. It's the first we've seen it. I don't know if it's a trend, but this product has to work. It has to provide returns for investors in order for it to work. Now, they are improving the SPAC structure, and the more recent ones are doing better. They're still not having the performance we think they should relative to the regular way IPO, but they are doing better. So there's a lot more improvement in the structure of these so that this can work. And I will say, I think, spending a lot of time in the regular way IPO market, SPACs have sort of picked up an area of issuance that maybe could have tapped the IPO. In the internet bubble days, there were the whole market got to be so ridiculously valued with companies that had no revenues, and the business models were so hard for anyone to figure out. They shouldn't have been public. But this may be just a great route for companies like that to raise capital, and we can keep the sanity that's in the regular way IPO market around for a while.
It's tremendous difference in performance, so investors need to be careful. So talking about IPO's performance, your ETF has delivered really impressive performance which I mentioned earlier too. And again, it's the Renaissance Capital IPO ETF, ticker symbol, very easy to remember, IPO. Tell us a little bit about this ETF and the index's approach in selecting and weighting companies.
Sure. The way we set it up is it's a basket of the last two companies that have gone public within the last 2 years. They have to be at least, we take that universe, it has to be in the top 80% of the market cap of that universe. So they're the larger, more liquid ones. And then the portfolio is weighted by float adjusted market cap. So it reaches into the underlying liquidity, and float is really important. And I think the importance is this. This is not picking up shares at the time of the IPO. These are all being picked up once they trade during quarterly rebalances, or if they're really big, they'll go in within 5 days of trading on a fast entry basis. So, for example, rocket companies had that fast entry, and other large companies have come in on that basis. But the interesting thing about this construction is we're able to avoid, when you get to the larger, looking at year to date, I looked at the IPOs that did 500 million deal sizes or greater, and their first day pops were 16%, whereas the average first day pop of the market so far this year has been 35%. So when you err on the side of the larger, more liquid, you get a little better, I think, price discovery with these companies, because they're large and the market has to absorb them. So it's a better, less volatile portfolio when it includes the larger, more liquid ones. So that's how it works. And it's been a very strong product, particularly this year. And as I mentioned, particularly because IPOs have always been new economy companies. And one of the issues with new companies is investors sell them off fast when the market gets jittery. And yet when the market got jittery this last March, no one was selling off these companies. And it turned out that that's because many of these companies were the companies that were actually thriving during this work from home time. So the number one constituent in our US IPO ETF is Zoom Video. And also Moderna's in the top 10. They're working on a COVID vaccine. CrowdStrike, Security, Datadog, Enterprise Software, Slack, and the corporate messaging. They've all seemed to play into what investors have been looking for. So these companies have traded well. Investors support a lot of money in, and it has benefited our US ETF for that reason, and that's why we've had such very strong returns. And if you look back historically, now the US ETF has been outstanding for over 5 years, and it's the alpha has positive alpha, so it has and strong risk-adjusted returns, which is great to see, because no one prior to this has really managed to index and the IPO space, which it turns out these new companies do have alpha. They take a couple of years to get into major indices in any way. They're always underrepresented because most major indices also adjust for float. And so it's hard to find these companies early on, like when Facebook first came out, big market cap, but small, much smaller, maybe issuing 13 or 15% of its shares. It looked like a company with this 13 to 15% of its overall market cap. So we're emphasizing these companies before they get in major indices, and they grow their valuations in our product, and then they become included in major indices over time. So that has been the strategy, and so far so good.
Yes. Let's talk a little bit more about some of the biggest winners and losers in the portfolio. And as you mentioned, the companies that have done very well are mainly due to those coronavirus-driven trends. For example, Zoom Video is one of the top performers. It's the top holding too, and that has benefited from the work-from-home trend. There's Neo, which has probably just benefited from the craze for Tesla or Tesla like the next Tesla.
Yeah.
And Moderna, as you mentioned, they're working on coronavirus vaccine. Pinduoduo, which is a Chinese internet and e-commerce company that has also benefited from work from home, stay at home, shop online trend. There are some companies which investors may not be familiar with. For example, GSX Teleedu, which is a Chinese online education company that has done very well this year. And looking at the losers, some of the most high-profile IPOs of 2019, for example, Uber and Lyft, they have suffered a lot because of this pandemic. So talk a little bit more about some of the top performers and worst performers.
Yes, and I think that's why Uber and Lyft struck such a blow to, and the performance, such a blow to other companies like it, and it kind of froze the marketplace because they were such highly valued unicorns and just had had to be cut back in valuation and continue to have poor performance in the IPO market. And then COVID hit, and well, now that story's been told. But I would say, I mentioned some of these work from home, but let's take something like NEO. Quite honestly, I think it was very hard to figure out that what's been going on with Tesla. And NEO, I mean, I think as an active manager, wouldn't have been a company I would have selected. Even when Tesla went public, I've always been pretty nervous about that company and what it's all about. So there are, in this strategy, this is a rules-based strategy. So they're going to be the losers like the Uber and Lyft that, since they're big and they got through the IPO process with a lot of eyes, and it's a pretty institutional process now, they got through and performed poorly. And, the IPO market reacts pretty quickly. When something like that happens, it basically shuts down, not interested in other companies that look like it. So, NEO got out, and honestly, I'm amazed to see it's a top 10 holding. There's tremendous interest in these, and so this rules-based index has, it does include some of these losers, and then others that would surprise you that got in and had incredible performance. In general, the strategy has managed to find, because it is on the larger, more liquid, find the better IPOs.
So you mentioned earlier about Trump administration's plans to force some of these Chinese companies to delist from American stock exchanges if they do not comply with our accounting standards. Do you think that proposal or those concerns could impact some of the Chinese IPOs in the CTF?
Yes, I think this is an important subject. Already the SEC is requiring the Chinese companies that are listed here, Chinese ADRs, to comply with the full rules that every U.S. company has to comply with when it comes to accounting oversight. And it's been problematic for the Chinese companies because that means opening up their books in a way that their structure doesn't allow. But we had allowed this to go on for a long time, and whereas the U.S. companies had to comply with the PCAOB rules, that's what they're called, the Chinese companies had this carve-out, and that carve-out's ending, and for all listed Chinese ADRs, the date that I see the SEC put on this is at the end of next year. These companies will have to comply, or they will be delisted. And so we're seeing some of the Chinese companies already here hedging their bets and listing in Hong Kong. And then also we're seeing a rush of Chinese companies still here to get in time to at least get some time in our marketplace and raise US dollars, and with full knowledge that they're either going to have to figure out how they comply with these, or they will be delisting or backing this up with a listing in Hong Kong where they'll delist and still have the tradable liquidity outside of the US. So that brings up an interesting thing because we know that's why Lufax, I think, is rushing to come public here. We're seeing this IPO of a electric vehicle company called XPeng, $1 billion IPO coming out this week. And so we're seeing that rush, and that's happening. But we are now seeing more companies look to list in Hong Kong. And I think one of the most important ones of all is Ant Group, Ant Financial, which is the fintech arm of Alibaba. Had been spun off from Alibaba, who still owns a chunk of this company. And this IPO is going to be an incredible IPO. I'm sure every exchange everywhere in the world, including our own, would have liked to have this listing. It's going to list in Hong Kong and Shanghai, and could raise up to $30 billion and be valued at about $200 billion. If it raises near that $30 billion, it will be the largest IPO globally ever. Prior to that, the largest was Saudi Aramco, raising about $26 billion. And prior to that was Alibaba, so Alibaba's own IPO, which was done here in the US. So this Ant Group, and we just looked at the filing for Ant Group. It looks like it's going to come in October. And it's an incredible company. It has about $20 billion in revenue. It's growing at about 40%. It has 30% net margins. It has like 1 billion active users of its payment platform, which was built up because it was the payment platform for Alibaba, the largest e-commerce company in China. So this is going to be a major IPO, and it will qualify, it looks like, but we have to determine it. As the largest IPO, it's going to very likely to be a candidate to be included in our international product, the Renaissance International IPO ETF, which has a symbol IPOS. And for U.S. investors, if they're knowledgeable about this, that ETF makes it easy to access non-U.S. companies in a U.S. dollar vehicle. So you can buy IPOS in your account in dollars. Yeah. And so it will have Ant Group. I'm sure other indexes are going to look at Ant and try to figure out how to get them in there. But this is what we're all about. We're all about trying to capture these kinds of companies.
Yeah, Ant Financial is definitely going to be very interesting, and it is still controlled by Jack Ma, Alibaba founder. And as you mentioned, it is expected to fetch a valuation above $200 billion. And this could be the biggest IPO ever if they raise about, you said, $30 billion. Okay. And this is a very profitable company, which you also mentioned, unlike many other IPOs, which are loss-making firms. And just recently, we learned that they had more than 1,000% jump in their profits in the first half of 2020 from the same period last year. But obviously, the company is planning to list on the Hong Kong and Shanghai stock exchanges, not in the US, unlike Alibaba. And you talked a little bit about your international IPO ETF, IPOs. That has also delivered very impressive performance this year. I saw it is up about 38%, which is, especially impressive because most international ETFs are still down for the year. Would you like to talk a little bit about IPOs?
Sure. It has the same theme in a way of the U.S. product, and many of these holdings are holdings that are new economy companies. It used to be non-U.S. Investments had a lot of financials and other big state-owned enterprises for China. But this product is all about the new companies that are going public, and they tend to be the new economy. Our number one holding is a company called Meituan Dianping. That is a food delivery giant in China, and that's had tremendous returns for our product. It's the number one holding. Xiaomi, which is the smartphone maker of China, the inexpensive alternative to Apple, And that one's really helped the portfolio. That's the second largest holding. And then companies such as, there's a company called TeamViewer. They're a German company, but their product is remote connectivity for enterprises. So it's like owning, it's in the category of Slack and other enterprise connectivity. So those are the themes that have really propelled this. We have payment processors in this ETF. We've had good returns from an Italian payment processor called Nexi. I will say that the emphasis of IPOS right now has been China. About half of the portfolio now includes these big Chinese companies. That's not always been the case, but with this product, we let the investment flow where it is, and so we have a lot of Asia and China right now. That may not always be the case. Europe is a little bit sluggish in terms of the IPO market right now, but we've had in the past some good returns from Europe. For example, Adyen for a long time was part of the portfolio. They're one of the major payment processors in Europe.
Definitely very innovative, very interesting companies. That's all we have time for today. Kathy, thanks so much for joining us today and for sharing your insights.
Thank you, Nina.
Thanks for listening. If you want to learn more about these ETFs or IPOs in general, please visit renaissancecapital.com. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.